Assalamu alaikum. I am Jawad Ahmad. Today we are present in our next economics class in which going to study the ninth learning objective of our chapter, that is the determinants or the factors affecting elasticity of supply. So before we can start this interesting topic, kindly subscribe my channel so you can get all my videos on a timely basis. Let's start this class. What are determinants? We have already studied this concept in previous lectures. Determinants are the factors affecting or responsible for bringing any change in elasticity or the required topic that you are being studied. So these are the factors that can cause change in the elasticity of supply. First one is time period to respond. We know that there is two type of time periods. First one is short run time period and the other one is long run. Short run is a time period in which any one or any other factor is fixed and all other are variable. Short run means a short span of time, limited quantity, limited time, or short span. Whereas in long run, all factors of production are variable. Means if you want to increase your production, then it can be possible in long run as compared to short run. So if a product can be prepared in a short period of time, then its elasticity will be different from the one that required a significant time of period for its production. So supply will be inelastic in short run because some of the goods cannot be manufactured at a very short period of time. They need some plenty of time to process and reach to ultimate stage where they can be used for customer. For example, agriculture products. So supply will be inelastic in short run as firm can increase in production and capacity in long run by installing new machine or new factory, but this cannot be possible in short period of time. So supply will be inelastic and the seller have to sell its product at a higher prices in short run time period. Whereas supply will be elastic in long run because a big change can be unexpected in long run time period. Second one is possibility to store stock. If there is a facility to store the item for a long period of time, then supply will try to hold supply of its product and will try to sell them in the market when their price goes to higher. If store capacity is available, then supply will be elastic, otherwise it will be inelastic. As as the supplier can hold supply of its product in the market due to their nature. Some of the products are perishable goods. They cannot be held for a long period of time. So for such goods, supply will be inelastic because the supplier will try to sell them at any price level in order to avoid any loss that is or that can be sustained in perishable goods, whereas supply will be elastic in case of durable goods because they can be old and they can be old in any store and will be sold in the market when supplier will get the favorable sale price of its product. Third one is availability slash mobility of factors of production. If factors of production are easily available, then supply will try to increase its production at any level. So supply will be elastic. If there is highly availability and easy mobility of factors of production in the locality where the factory or the warehouse of the company is being located. The next fourth one is the spare capacity. What is spare capacity? Its name is also describing it. Spare means some extra. Capacity means production capability. For example, if you are in a routine of production of 100 units within 20 hours, but some time is left from the skilled labor time. For example, let's say you have a total limit of 30 hours in the factory. Your you are in a routine of or your laborers are in a routine of producing 100 units within 20 hours and the remaining 10 hours they spend it as a spare time. So here you have 10 hours spare capacity that can be utilized in order to increase the production of the company. So, if your company has such spare limit or spare capacity, then you can increase your production as well as the capacity level by giving different kind of incentive to the labor or within the available resources that are being offered to them. So supply will be elastic if there is a spare capacity, otherwise it will be inelastic. The second loss is production time. Some of the products take a bit longer time as compared to others. If a product is prepared in a short period of time, then its supply will be elastic because you can make any change in the price of the product because it is shortly available or it can be available at a very small limit of time or you can reproduce it in a short span of time. If there is such product that take subsequent or substantial period of time, just like agriculture products and other ones, so your supply will be inelastic. You cannot change or you cannot easily change your supply of the products in the market as they need a subsequent or a substantial period of time to reach to a ultimate final stage where they can be used or customer need or they can be sold in the open market. The last one is barriers to entry. Every market has its own rules and regulations. Every business that want to operate under this market need to abide by with these all rules and regulations. If these rules are very strict, then it will create high level of barriers in the market, making it difficult for other business to enter into the market. So in this case, your supply will be inelastic because the customer have to purchase product from a few or limited suppliers in the market at their own favorable rates because there are high barriers in the market and new suppliers cannot easily enter into the market. So it was an easy topic of the concept has been well explained. Let's meet in the next class with the 10th learning objective. Let's meet in the next class with the next learning objective. Thank you for your time.